If you are a beginner, this is the only investment guide you need. Hey, my name is Shin. I graduated from UCLA with a degree in business economics where I studied finance and investment, and I've read over 50 investment books over the years. In this video, I've summarized the most important investment framework that I have learned along the way into 6 key pillars, which will save you years of researching and learning. I've put the timestamps below, so feel free to use them. Let's start. Pillar 1. Understanding the power of compounding. Why is investing important? One of the key reasons is the power of compounding, which is a magic that can help your money grow significantly over time. So what is compounding? Compounding is when the interest you earn on your investment earns more interest. This means you earn money not just on the original investment, but also on the interest that builds up over time. Let's say you invest $10,000 at an annual return of 10%. Here's how compound interest compares to simple interest over different periods. So what's the point? The longer the investment period, the greater the return differences. The earlier you start investing, the more time your money has to grow through the power of compounding. This means even small investments made early can grow a lot over the years. Pillar 2. Understanding risk and return. Understanding the relationship between risk and return is important for investing. In the investing world, the general rule of thumb is the higher the potential return of an investment, the higher the risk involved. So lower risk investments usually offer lower return and vice versa. Now let's dive into the 4 different types of investment risks. Market risk. This is the risk of investments losing value due to market downturns. For example, if the stock market crashes, the value of your stocks can drop significantly, even to zero. Credit risk. This is the risk that a bond issuer will default on payments. For instance, if you buy bonds from a company that goes bankrupt, you might not get your money back. Inflation risk. This is the risk that inflation will erode your returns. For example, if your investment grows by 2%, but inflation is 3%, your purchasing power actually decreases. Liquidity risk. This is the risk of not being able to sell an investment quickly at a fair price. It might be hard to find a buyer quickly without dropping the price. Now let's talk about the key concept, risk tolerance. Your risk tolerance is basically how much risk you can handle without panicking. It depends on several factors. Age. If you are 25, you have more time to recover from losses, so you might invest more in stocks. If you are 60, you might prefer bonds or other safer investments because you have less time before retirement. Income. If you have a stable, high income, like a software engineer earning 100K a year, you might take more risks. If your income is lower or unstable, like a freelancer with variable income, you might take fewer risks. Financial goals. If you are saving for a house down payment in 5 years, you might choose safer investments. If you are saving for retirement in 30 years, you might invest more in stocks for higher potential returns. Investment timeline. If you need the money soon, like for a child's college tuition in 3 years, you might avoid high-risk investments. If you don't need the money for 20 years, you might be more comfortable taking risks for potentially higher returns. Pillar 3. Investment options. Now let's dive into the nitty-gritty of the different investment options available. Stocks. Owning stocks means you own a part of a company. When you buy stocks, you become a shareholder. A stock can make you money if the company does well and the stock price goes up, or if the company pays dividends, which is a share of profits. For example, if you buy Apple stock, you own a small part of Apple. If Apple performs well, you could earn money from rising stock prices and dividends. Index funds are a safer way to invest in stocks because they spread your money across many companies, like those in the S&P 500. Bonds. Bonds are like loans you give to the government or companies. They pay you interest over time. For example, if you buy a US Treasury bond, you're lending money to the US government, and they pay you back later with interest. Bonds are generally safer than stocks, but still have risks, like if the borrower can't pay back, or if inflation reduces the value of your interest. Mutual funds. Mutual funds pull money from many people to invest in a mix of stocks, bonds, or other things. They offer a mix of investments and are managed by professionals. For example, the Fidelity Contra Fund invests in many companies aiming for long-term growth. However, it's important to remember that most of the mutual funds do not perform better than the market over the long term. Exchange-traded funds. ETFs. ETFs are funds that are traded on stock exchanges. For example, the SPDR S&P 500 ETF follows the S&P 500 index. ETFs offer a way to invest in a variety of stocks with low fees, and you can buy and sell them throughout the day. Real estate. Real estate investing involves buying properties to earn rental income or to sell for a profit later. This includes houses, office buildings, and real estate investment trusts, REITs, which are companies that own real estates. Investing in a REIT like the Vanguard Real real estate ETF lets you invest in real estate without buying properties directly. Cryptocurrencies. Cryptocurrencies are digital currencies like Bitcoin and Ethereum. Their value can change a lot because of demand. They are extremely risky because their values are not based on physical assets or companies. Their prices can swing wildly, and they face regulatory changes and security issues like hacking. So these are the 6 main types of investments you can consider. Each has its pros and cons, so it's important to understand them before you start investing. Pillar 4. Basic investment strategies. Let's look at some important investment strategies one by one. Buy and hold. This strategy involves purchasing investments and holding them for a long time regardless of market changes. It reduces trading costs and takes advantage of overall market growth. For example, if you bought Amazon shares 10 years ago and held on to them, you would have seen significant growth as the company expanded and its stock price increased. This strategy avoids the risks of trying to time the market, which can be very difficult and risky. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, no matter the investment's price. For example, you can invest $100 every month in the S&P 500 ETF. This way, you buy more shares when prices are low and fewer shares when prices are high. This strategy reduces the risk of investing a large amount at the wrong time. Index investing. This strategy involves investing in index funds or ETFs that track a specific index, like the S&P 500. It offers broad market exposure, low costs, and lower risk compared to picking individual stocks. For example, the SPDR S&P 500 ETF allows you to invest in the entire S&P 500 index, which represents the overall US stock market. This diversification helps spread out risk and provides a simple way to invest in the market's overall performance. Growth investing focuses on companies expected to grow at a high rate. These companies might not be profitable now, but are expected to be in the future. For example, investing in Tesla offers potential high returns but also higher risks because these companies are often more volatile. Value investing. It involves picking stocks that appear to be cheaper than their true value. It targets undervalued companies with strong fundamentals, potentially providing steadier returns and lower risks. For example, investing in Johnson & Johnson for its strong fundamentals and undervaluation compared to its true worth. Income investing. This strategy focuses on investments that generate regular income, such as dividend-paying stocks and bonds. It provides a steady cash flow, which is a good option for risk-averse investors who prefer predictable income. For example, investing in companies like Coca-Cola, which pays regular dividends, can provide a reliable income stream. Diversification. This strategy involves spreading your investments across different asset classes, sectors, and regions to reduce risk. The idea is not to put all your eggs in one basket. For example, a diversified portfolio might include stocks, bonds, real estate, and commodities. By spreading your investments, you reduce the impact of poor performance in any single asset, which helps to stabilize your overall returns and reduce risk. Pillar 5. How to analyze investments. Analyzing investments is important for making correct decisions, and this process is called fundamental analysis, which involves evaluating a company's financial health and overall performance using 2 main ways: quantitative analysis and qualitative analysis. Let me explain. Quantitative analysis looks at a company's numbers to understand its financial health, and here are some key metrics. Price to earnings ratio, aka PE ratio. This ratio compares a company's share price to its earnings per share. It helps you determine if a stock is overvalued or undervalued. For example, a high PE ratio might mean investors expect high growth, while a low PE ratio might suggest the stock is undervalued or not growing as fast. Earnings per share, aka EPS. EPS measures a company's profitability on a per-share basis. It shows how much profit the company is generating for each share you own. Higher EPS generally indicates better profitability. Return on equity, aka ROE. ROE measures how effectively a company uses shareholders' equity to generate profits. It shows how well the company is using the money invested by shareholders to grow the business and generate returns. In general, the higher the ROE, the better. The second, qualitative analysis. Qualitative analysis looks at no-number factors that affect a company's performance. And here are some key factors. Management team. Evaluating a company's leadership is crucial because strong leaders drive the company's success. Look at the backgrounds of key executives like the CEO and CFO to see their past roles and accomplishments. Check how the company has performed under their leadership. For example, Tim Cook's leadership at Apple has been key to its ongoing growth and rising stock price. Industry position. Assessing a company's position within its industry helps you understand its competitive strength. Look at its market share and what makes the company stand out, like advanced technology or a well-known brand. For example, Amazon's strong position in e-commerce is due to its vast delivery network, wide range of products, and popular Prime membership. Market trends. Understanding market trends is important because they can impact a company's future growth. Keep an eye on economic indicators, new technologies, and changes in regulations. For example, the global shift towards renewable energy benefits companies like Tesla, which focuses on electric cars and clean energy solutions. By using both quantitative and qualitative analysis, you can get a complete picture of a company's financial health and make better investment decisions. I've created a PDF summary of everything I covered in this video, so if you want to review all of the concepts later, click the link below and I'll send it to you. Thank you so much for watching, friends. I hope I didn't waste your time. If you enjoyed it, please give a like and subscribe to my channel for future investment contents like this. It means a lot.